But Barney, I'm super excited to have you here. I have been looking forward to this talk for a while. Our friend Kobe was like, you need to talk to Barney. He knows everything about reinsurance. It's this really interesting space in the climate finance stack that I honestly don't know much about besides the research that I've done here. And I'm excited to just learn a bunch more about. So the intro for you is you're the head of Nephila Labs, and you've been there since the beginning. Your responsibilities include oversight of research and insurance tech. You were also involved in investor relations, business development. You began in reinsurance in New York in 1993, and I think also an undergrad, if I'm correct, which you can talk about. And as a broker for Marsh & Guy Carpenter, you joined Goldman Sachs in their risk markets group in 1996, joined XL Capital in 2003, was head of marketing for their weather risk management business. You're also the chair of the board of, is it Ceres?
That's right.
Correct? And I'll ask you more about that later, but you essentially wear these hats around risk and climate. Those are the two main themes that I'm very excited to go deep in with you. But first, thank you for being here.
Thanks for having me. I appreciate it. I appreciate Kobe suggesting me, and always happy to talk about this increasingly interesting corner of the financial world.
Yes, amazing. So first, actually, I want to start with some definitions, and if we can be as if I'm a 5-year-old or a 25-year-old, but like new to reinsurance, 32. Explain what you mean when you think about risk.
Sure. So risk ultimately is the way that most people think about it is something could go wrong, right? You have some uncertain future, some probability that something may happen which is unexpected, different than normal. Sometimes that can be positive, obviously, sort of an upside surprise. The sun comes out in London, or you win a lottery ticket. But usually, when people think about it, they think about a downside. What if I slip and fall? What if there's a hurricane? What if I own a wind farm and the wind doesn't blow? What can I do about that? And historically, people can either address that operationally, or they can address that financially. You can either say, I'll not go outside if it's raining, or you can say I'll bring an umbrella with me, and therefore I have access to something that protects me when things go sideways. And so I've always been interested in risk and probability and games, and that ultimately led into being part of this business where insurance companies obviously think a lot about risk, capital markets, financial market companies think about risk, and reinsurance companies, who sort of the backstop to the insurance industry, think about risk at that higher level of abstraction. So when we think about risk, really it's a question of probability, and we think about that, it's really a question of likelihood that something happens and the severity of whatever that might be.
Amazing. That was great. I feel like if I was 5, I would still understand that. And also, just for the audience, I should have said this earlier. Barney and I will go back and forth for about 40 minutes, and then the last 20 minutes will be Q&A. Because it's smaller, I think just drop your questions in Zoom chat, and at the end, we'll just ask you to come up and ask your questions if you raise your hand. So it can be a nice, intimate sort of Q&A. But I think we'll skim the surface on some things. We'll go deep on some things, but if you want to go deeper on anything, definitely use that as your opportunity to have a one-on-one chat with Barney. Okay, so we know what risk is, unexpected things. We think about probability. That makes a lot of sense. And then you touched on insurance and reinsurance. And so I think we all know generally what insurance is. Can you explain what reinsurance is, how it started, why it started?
Sure. So, there's an old expression from here in London, where I am today, that was around the beginning of Lloyd's of London, which said that it's better for risk to fall upon the shoulders of the many than the heads of the few, right? So insurance, most people know, you just think of a bigger pool of risk. It's very hard to predict, will my teenage son get in a car accident at any given day or any given year, but it's much easier to say over a pool of 1,000 drivers or 1 million drivers, how many people are going to get in an accident in a given year. So much more reliable statistics. And that's the basis of insurance, whether that's life or health or auto, is that over a big enough pool, you're spreading that risk and you can get a better handle on the statistics. Reinsurance started, and so this philosophy was followed as countries urbanized. So each city, in other words, would have an insurance company for that city to protect, for example, buildings against fire. And then there was a fire in Cologne about 150 years ago where all of the buildings burnt down. And so the local insurance company felt like, well, I thought I was diversified because I was across neighborhoods and across types of house. But as it turns out, there are events that are large enough that I, as Cologne Insurance Company, can't really diversify away from. And so they created a company, which was at the time called Cologne Reinsurance. And what they did is they went to every city or town in Germany at the time and said, if there is an event that is so large that it's too large for you, we will ultimately hold that risk. And we'll get a premium from each of these individual cities. And that will be enough so that if one of you has a bad year, which is possible, it's not just your own resources that you draw upon, but there's another level of effectively insurance for insurance companies. And over time, each country, and some of those still last till today, Cologne Re isn't around anymore, but Swiss Re and Munich Re and Hanover Re, and these companies started with that basic goal in mind, which is you need somebody at a higher level within the country to take that risk. And so for the past 150 years, what you've seen is when insurance companies themselves are concerned about their diversification or concerned about the scale of an event, earthquake in Tokyo, for example, Japanese insurance companies, not a whole lot that they can do to diversify away from that, or California insurance companies, can they then go buy some further protection from somebody else? And that became a business that was a separate and distinct business where the expertise was like looking down into each of these insurance portfolios and saying, how do I estimate the probability, not of normal day-to-day behavior, but of something that's large enough that it could possibly impact me?
Excellent. So my main takeaways are, one, I love the analogy that you just have a bigger pool, so that creates more reliable statistics. It's about diversifying and also, being at this higher level. And it also sounds like there's a value, or like, to be a good insurance company, you have to be good at estimating probability, right? And so if you're better at estimating probability than another insurance company or another reinsurance company, then you probably end up doing better in the long term.
That's right.
This feels like the God question, but like, God created everything. Who created God? Like, is there sort of this like higher level reinsurance? Is that like the World Bank? Like, how do you think about where does the buck stop, or is there no layer above reinsurance?
Well, that's an important question. So historically, the layer above reinsurance is ultimately you run out, right? Just like your insurance policy. It actually goes back to the insurance company. But the whole way that my career started at Nephila and is related to this, which is in 1992, a big hurricane hits Florida, not a major city, but near a major city, and causes a lot more damage than people thought. They weren't really using computers in the insurance business at that point in time. They were sort of counting rooftops and guessing. And it turned out their guesses were wildly off. And then similarly, 2 years later in California, a big earthquake hits near LA, but not LA, does a lot more damage than people thought an earthquake like that could do. So there was all of a sudden a recalibration where the insurance industry thought, well, maybe we do need a backstop, or maybe we need augmentation. Maybe the existing reinsurance capital base is not going to be big enough. And that led to the idea that perhaps you can take this risk and package it and then sell it as an investment to the broader financial markets. You can get another reinsurance company, or you can reinsure a reinsurance company, but in the end, that's a relatively small pool of capital. Whereas if you could say, let's take that risk of an earthquake, package it into a security, and sell that security that's exposed to an earthquake in Japan to investors who are in Canada or Florida or Brazil, to them, that's a diversifying risk, right? They don't have any exposure to that. It's a nice incremental part of their portfolio. And if you get the probabilities right and they're paid more than the probabilities, now you have opened a door to a much bigger market that can support all of this risk. And that was what I wrote my undergraduate thesis on. A lot of people were talking about this idea in the early 1990s because mortgages and credit cards and other things were being securitized. And since you had this need for more capacity on the one hand, and investors seeking for new things to invest in on the other hand, it appeared that there might be a business sort of standing in between those two forces and saying, this is good for you as insurance company or a homeowner or a taxpayer, because the risk is finding a home. And this is good for you as an investor because you're creating effectively a new asset class. And by the way, the best thing about that asset class is no matter what happens in the stock market or to Bitcoin or to interest rates, that doesn't make the wind blow or make the earth shake. And those are very valuable things to have in your portfolio if they do not move at all with other financial markets, if they have zero correlation. So your question is an important one because that's ultimately what unlocked what's now called the insurance-linked securities market.
Okay, incredible. So you just answered three of my next questions. By the way, Blake, thank you for asking that question in Zoom. For everyone else, keep asking your questions in Zoom. We'll get to them in the last 20 minutes. And then I'll just keep rolling on this side. And so so it sounds like Nephila came out of, that question of how do we diversify even more, right? And how do we create something that is not linked to it's an asset class, but it's actually not linked in some ways to the capital market. Is that a fair way to say that?
Right,
Okay.
You're creating an asset, but that asset doesn't have any natural co-movement with all the other things and that was really proven, the first catastrophe bond, that first example of that sort of security, 1996, 1997. So 10 years later, when you had a general great financial crisis market crash where everything lost value, this was a sector that wasn't tied to any of that and therefore didn't lose value. And that was a real inflection point for investors who thought, oh, okay, there is something that doesn't move up and down when everything else moves up and down. I'd like to learn more about this. And that was a really important moment where more capital from around the world, largely from pension funds, said, this is interesting to me. I can see why I want to own some of this in my portfolio.
And so you mentioned both this is Nephila's origin story and also the creation of insurance-linked securities. Is that when you talk about Nephila, is insurance-linked securities one piece of it, or is that like the core of it? And what is Nephila, I guess, if you're thinking about it as this company? Sure.
So yeah, they're all intertwined, sort of my own personal story and Nephila and the market. So the first deal of that kind, the first catastrophe bond, as they were called in the early days, was done in 1996. Another one, two, were done in 1997. And as it happens, two friends who both, one worked in the insurance industry, one worked in the banking industry, said, this is interesting. These products are interesting. I would imagine some people don't want to evaluate each security themselves because they don't know anything about insurance, but they might hire an investment manager and say, you choose, now that there's going to be these new securities available, which ones are good or bad, which makes a lot of sense now, 25 years later. But at the time, there were three bonds. It wasn't clear there was an immediate need to tell you which, of the three to buy. Mm-hmm. But they started a fund in 1997. They started investing in 1998, and that became what's now called Nephila. And it was the first dedicated fund for these kinds of instruments. And it was very much an experiment at the time. And I knew them because I was at Goldman Sachs at the time, which was the bank that did the first few catastrophe bonds. And so we were the only seller of these instruments, and they were the only dedicated buyer of these instruments. So it was important that we meet. And over time, I got to know them better and ultimately joined the firm as a third partner in 2004. So Nephila, over time, has obviously grown and expanded from those original roots of buying those securities. And the business expanded into being a broader risk taker or a broader capacity provider. So we are an investment manager. We manage capital on behalf, like any venture fund or private equity fund, on behalf of institutional limited partners who give us their capital and say, go and take risk on our behalf, assemble a portfolio. And we have a variety of different vehicles and strategies that do that. But ultimately, we still act like this kind of synthetic reinsurance company. And that can be in lots of different forms in terms of how we execute. But the basic idea is exactly the same.
And most of your customers are still pension funds?
Most of our investors are still pension funds, yes. And family offices and endowments and life insurance companies, Mendit's Capital, sovereign wealth funds from around the world. But pension funds generally have very large amounts of capital. They care a lot about that non-correlation. They have return hurdles, which fit well to what we do. And on the other side, we sell protection to insurance companies, to governments, to wind farms and farmers and anybody else who's exposed to some sort of natural hazard, which could be property destruction, a lot of what we do, but could also just be weather fluctuation. It could just be you have a hydroelectric plant, and if it doesn't rain, that's a problem for you. And the World Bank says, okay, country that is dependent upon hydropower, go and buy some protection against drought because that's a problem for you. And we as the World Bank don't want you to come to us when that happens and borrow money. We want you to go ahead of time and arrange for payment if that risk happens. So the portfolio is gradually broadened over time in terms of what we can apply that financial technology to.
Excellent. Okay. I think this is my last like clarifying, speak to me as if I'm a 5-year-old question. So you've said diversify a lot, and I think of the word hedge and hedge funds and hedging, and are they essentially, are we talking about the same thing, or are they different in your mind?
I think they're different. So for a pension fund, they may say, I want to invest in the US stock market and the Japanese bond market and the gold market. And now I also want to invest in this insurance-linked securities market. Like they have different characteristics, they have different cycles. I want to have a portfolio that has lots of pieces to it, which makes sense. From a hedging standpoint, that's something that they could do. They could say, I just want to go and hedge my exposure to any one of these investments. More often, as you say, whomever is managing their capital can either just be long, can just take risk, invest in a stock market, hope that it works out, or they can be long and short. They can say, well, I'm actually going to hedge against my own outcomes. And we have done that, certainly in the context of our own business. So we might go to Florida insurance companies or Texas insurance companies and sell them reinsurance. And we might turn around and buy our own protection from another reinsurance company or another fund, which says, if several of these things are impacted at once, we want our own protection. So they're related in that the best portfolio has some diversity and has some hedging, but they're different tools. Sometimes you have a less diverse portfolio and more hedging, or sometimes you have a very diverse portfolio, you don't need to hedge at all, but they're just different levers that you can pull when you're managing risk and return. And by the way, different investors like different amounts of risk and return. Some investors say, I don't need diversity, I don't need hedging, I just want the risk itself. And I accept that that's risky. And others say, I really want to pare down the risk as much as possible where I can still make some minimal amount of return. And different people have different objectives.
Amazing. Okay. So I feel like you've covered so much, and I'm revisiting my questions and trying to figure out what makes sense to ask. I think we already talked about, well, maybe we can dig into this a little bit more, because I think that what I want to move into is both, how the reinsurance industry has shifted over the last 10 years, or maybe 2 years, right? Like if we can think about where it's sort of accelerated shifting, and then also link it to climate and that those being the themes. And so maybe the first question that I can ask is about this theme of like economic stability and non-zero sum with reinsurance and with this sort of diversifying, which I think you've touched on a little bit with the stock market and fluctuation there, right? And how this doesn't really, it's not as affected by fluctuations in the rest of the market. But is there anything else that you'd want to say about just like the sort of value of doing this from an economic stability world impact perspective?
Sure. So I think there are two important components to that. One is that, from a resilience standpoint, insurance at any level, if you're operating a small business or you're running a triathlon, like it allows you to take risks that you might not otherwise take, because if something goes wrong, somebody else will help you to shoulder that burden or foot that bill. So that's important. That's a shock absorber that exists in all kinds of economies going back, 1,000 years. Lloyd's of London, around the corner from where I'm staying today, started because ship captains would send their ships over the horizon, and 5 ships would go and 4 ships would come back, and you never knew who was going to be the unfortunate owner of a ship. So they agreed, let's just share, let's pool our risk. And they all met at a coffee house run by a guy named Edward Lloyd, and that became a place that you went to talk to other people who were doing risky things. And ultimately, that's where an insurance market was born, 350 years ago. So that idea has been around for a long time, of that sort of shock absorption. That's important from a resilience standpoint. It then enables people to do things that they wouldn't otherwise do. A bank might say, I understand you want to build a wind farm or a battery or a biofuel plant, but I'm concerned about, I don't know what cash flows are going to come out of that asset. I can either assume that they're going to be very low and be very conservative in my lending, or if somebody else can look at the wind or look at the variable cash flows and protect me against them dropping too far, then I can lend you more, and then you have more wind farms and more biofuel plants, and that helps with climate technology and how it works. The last part of the question, it was something that one of our investors said to us a long time ago, but I really liked it. And I think it's important, which is usually in most markets, somebody's wrong and somebody's right. You buy Apple and I sell Apple stock, and either you're going to be right or I'm going to be right on that transaction. It's a very zero-sum marketplace. But if I'm selling you protection against lightning strike because you're hiking around in the mountains and you're concerned about that, you don't secretly want to get hit by lightning so that you claim the money, right? Like, this is not, you're happy to pay that money away because it's important to you to have that stability. So we're aligned in that way. And it's not simply a matter of somebody wins and somebody loses. Like, and this is true, going back to the example of an earthquake hitting Japan, they don't want that to happen. They need money right away to recover from that. And they are happy if they don't have an earthquake to have paid away some of that money that they know they can survive as a society. And you've seen, you mentioned the World Bank, you've seen them encourage a lot of countries, Mexico and the Philippines and others, to say, please use this kind of risk management mechanism, because to recover after an event which impacts your economy can be very difficult. So if you can arrange ahead of time for some sort of resilience or some sort of shock absorption from other people in financial markets, that may be a humanitarian difference and a societal difference, which is really critical to that kind of economy.
Amazing. Okay, so we're going to go to, the shifts in the last 10 years, what you expect in the future, climate. Last 20 minutes are Q&A. Thanks for dropping all the questions in Zoom. But I think before we go into shifts in the last 10 years, I think you already covered a fair amount, but it sounds like you're on the lab side. You are an innovator on the finance side, which I think is interesting. And I think my thesis is just that there are these levers in climate that, if you shift it a little bit, it can unlock a lot of impact. I think finance and policy are probably the two biggest levers that I see. And so this question is just, what other products has Nephila created that have made a big impact? So we have the insurance-linked securities. I think you've mentioned some others, but what would be the most impactful ones that you that you believe have made the biggest impact?
Sure. So I think, the development of this market, which certainly wasn't just us, it was us and a lot of other people who believed in innovation in financial services. It expanded the market in an innovative way in two dimensions. So one was, it just made the market deeper. Could you actually now say, if you're the state of Florida or the government of Mexico, could you now access capacity that wasn't available to you in the reinsurance market? Maybe because it ran out, or maybe because the reinsurance market wasn't sure of the best way to deal with a specific risk. So partly just creating more capacity was the most important starting point. Mm-hmm. And then the second piece to that was expanding it to adjacent areas. If you can cover flood in the United States, can you cover flood, which is from a monsoon season that's too high in India? Can you actually provide that capacity in a place where it doesn't exist right now? I mentioned the wind farm example. That was a real life problem where we worked with some other partners to say, can we craft a product where you can go to a bank and say, if we offer this product, would you actually then finance more wind farms? Can you actually unlock more of that capacity? And so there isn't a sort of one or two specific products that I would point to, but that mindset of saying, if you can quantify this risk and you can articulate, what do you mean? What is the conditions under which you need some compensation? What are you willing to pay for that? Expanding that market. So it's not just either you buy insurance or you have the security or you go into the hedging market, but you can imagine a whole host of different kinds of risk transfer instruments for existing risks or for new risks. That was exciting to us. And that was why the group was called Risk Markets when I was at Goldman. And that's why Nephila has tried very much to refer to itself as a sort of risk transfer provider, is that the existing markets are incomplete, both in terms of what they cover, but also just geographically around the world. And so if you can help to create a more complete risk market, it's better for everybody.
Amazing. Okay, excellent. So going to how the reinsurance industry has shifted, let's say last 10 years and then last 2 years, or whatever time frame you actually think is the most compelling in terms of accelerating change.
Sure. So, the initial shifts back in the 90s was after those events and after the creation of this market, you had a conversion to using computers and technology for the first time. And that was really specifically around estimating the probabilities of natural catastrophe events. And I think you've seen a similar shift over the course of the past, let's call it 5 to 10 years in two ways. One is getting a better handle on the actual risk that insurance companies are taking. So insurtech startups or climate tech startups may have an insight or an ability to generate and analyze imagery or other tap into sources of information or tap into computational technology to give you more information about the risk that you're covering. And that could be as simple as telematics, where are you driving, when are you driving, how fast are you accelerating? Like, that's useful information that was never available before because it was just too expensive to capture. So there are many examples of that, monitors of people's health for health insurance, sensors on people's houses for earthquake insurance. Like, you now can apply technology in a host of different ways to give you better information about the risk itself. And that could be the risk as in, are you better at seeing where it rained and where it did not rain for a farmer? Or it could be risk as in, what is your building made out of and who's in it and what is it worth? And instead of doing a lot of that by hands, technology obviously can allow you to do that at scale. So that's one big change. And the other big change I would say is there is an awareness that as we grapple with this problem of climate change and what that means for existing capital market systems, is trying to figure out how can you help people in the face of that. You have lots of startups and lots of academics and lots of others looking at, here's what we think may happen. But if you're a company that's thinking about that future, you can either, again, change things operationally, move your warehouses away from the coastline, or you have to try to manage this risk financially, which is, I'm going to need to buy some protection against something which may impact me, which might not have impacted me before, a number of days over 100 degrees inside of a city where that's becoming a problem for, health at a hospital, for example. So the idea that instead of looking at insurance and reinsurance as sort of a very classic repetition of what it has been for 150 years, and really expanding using technology, both computational technology, but financial technology, and saying, what new directions can we take this market in to make it more complete? That's been the biggest change for sure.
And I think in Florida, there are some areas where you just can't get insurance anymore, right? Like that's something that seems to have been shifting. Is that fair to say?
Yeah, it's a very thorny problem in the United States. Everywhere, but particularly in the United States, which is insurance today isn't really a free market in the sense that people think that it is. A local state regulator will say you can't charge more than a certain amount, or information that you may not be able to use in determining a price. For example, for wildfire in California, people are testing new modes of predicting where they can occur or how they might occur, but it's not clear you can use that information to price a homeowner's insurance policy, for example. So because of that, often insurance companies' only ability to adjust their portfolios is not to change the price in the way that they would seek to do, but just to leave, to say, well, I guess I don't want to be in this particular geographic area anymore. And that often means that the state, whether it's literally the state of Florida or whether it's the National Flood Insurance Program or FEMA, becomes the insurer of last resort, which means, you and I and every other US taxpayer effectively become the insurer of last resort. And that's a problem in that you don't have a true price signal. And if we were shopping for houses in Florida, it might be useful to know, like, these are areas where it's very, very expensive, or Nantucket or Phoenix or other places that have obvious climate challenges. People, if they're thinking of moving or they're thinking of investing in a business or taking out a mortgage, it would be useful information to know where things are getting riskier or not. And there are climate technology companies that are obviously trying to do that, but making its way into insurance pricing signals hasn't necessarily happened yet. And part of that is regulatory. Part of that is insurance is always offered as a 1-year product and not as a 3 or 5 or 10 or 20-year product. So even if you're building a building next to the river that's going to be there for the next 20 years as you pay down your mortgage, you're not getting information about, well, where is that river going to be in 20 years? You can go and try to find it. It's often publicly available, but you're not getting that in your insurance pricing. So that's a problem I think that the insurance industry and the mortgage industry are going to have to grapple with in this next 3 to 10 years for sure.
What do you think, if you had to guess today, what do you think will happen? Do you think policies will change? Do you think that the timeline will shift? Do you think new asset classes will have to be created? Like, how do you see the next 5 to 10 years changing or looking?
Well, what I would like to see is more of this information and more of this technology that's out there getting incorporated into decision-making. And as you mentioned earlier, part of that is policy decision-making. How do you design good policy? If you had a house that was on the water in Florida that was destroyed, should you rebuild the house on the same spot in the same place, or should you actually have some capability to take that money and go somewhere else that's inland, or which often isn't allowed under the terms of existing policies. So can you change regulation? Can you change the way the market works? And I think ultimately people are going to change where they live, right? There's just going to be inevitably a migration to different areas than have been desirable before. And that's happened throughout human history, but I think it's going to continue to happen in a way which it will either be as a result of losses or will be as a result of signals that people get in advance of losses. And it's obviously be much more humane for it to be the latter, but it may wind up being the former.
Awesome. So I'm going to let people dig into policy a bit more in the Q&A. One thought on the tech was just, I think about quantum computing as a sort of, really cool, exciting technology that actually is helpful in climate tech because it's helpful with fusion. And it seems like it's also helpful in reinsurance. And so just thinking about all these, societal changes, technological changes, converging and creating, changes that I would never expect is cool. So going to climate tech, are there any disconnects between the reinsurance business and climate tech today? Do you feel like they talk to each other well? Do you feel like they're, sort of working well together? Or do you wish that there was more communication there?
I don't think it's a seamless process right now. I think that there's a classical story, which we've seen many times over the course of the past 15 years, where a small technology company believes that it has an insight or some data that a large existing insurance and reinsurance company should care about, but they have a very difficult time connecting with one another. And I mean, maybe some observations just from that process, because we've worked with and advised a lot of companies in the climate and insurtech space. One is an insight or new data is not a business, right? So, and I think we come across this time and time again, where a scientist or a computer scientist feel like, well, now we have more information. Shouldn't somebody want to buy this information? And that's not necessarily the case. It may be information which is bad news. They're not super excited to pay you money to find out the bad news, or maybe information that doesn't translate well into how they think about their business today. And so bridging that gap between insight or information and how it can actually be used, is really a gap that is hard for a lot of companies to cross. And to that end, we've seen a lot of companies that have built some sort of climate or insurance technology and then said, once we build it, we'll go out and find somebody who will want to use it. That has generally been less successful than going to companies ahead of time and saying, I think that I could tell you more about rainfall or housing information or whatever it might be. What is it that you want to know? What are the questions that you want to know? And then I'll go away and build something that can answer those questions. And that can sound obvious, but the sort of, if you build it, they will come, eventually you'll find a customer. That's been a lot less successful than people who sort of start even with a small market segment, say, I'm going to solve a distinct problem and then expand from there. So I'm optimistic. I think the amount of money and energy and resources being directed at climate tech, broadly defined, is fantastic. And I do think that any risk-taking company, not just insurance companies, but banks extending mortgages or municipalities thinking about their future tax base, or real estate investors who are thinking about their overall portfolios, all of those companies, you could argue, are going to want some more information about what is the climate today and where is it going. But it's finding sort of the right connector to attract their attention and make sure that there's a real use case for them. That's the hard part.
Good. So that immediately leads into my next question, which is, we have people who are very interested in innovation in climate, right? Whether they have spent a lifetime in climate or a lifetime in tech or business and want to use their skills in climate and to sort of make an impact. And a question that I ask almost everyone is, like, knowing what you know about the industry that you're in, where would you suggest that people interested in climate risk and finance focus their energy? You can be as broad or as specific as you want to be.
So I think there's two important areas that people could spend more time in. One is around disclosure. Obviously, there's a lot more investor focus on, I would like information about the climate risk that companies are exposed to. And that can be their specific risk of that company's operations, physical risk or transition risk. That could also be just their emissions profile and what is scope 1 and what is scope 2 and what is scope 3 and how are they going to report that. That's obviously the topic of debate at the SEC right now is trying to require more input from companies. And generally everywhere else around the world, it's not a topic for debate, it's just required, in England or in China or in Germany, like you just have reporting requirements. People are paying much more attention to this. That's not something that it's obvious a lot of companies know how to do themselves or asset managers know how to do themselves. There's a whole alphabet soup of different standards and different data inputs and different outputs. That's an obvious area that technology could be helpful, is around that reporting, around that disclosure, around standardization. And there are a lot of people working on that, but it does feel as if that's not going away. Once you start doing that kind of reporting, once you start caring about those levers in your business, you're going to need to understand much better how they move and when they move and what the impact is for you and on your earnings. And that's obviously going to be a topic that most investors now really care about because it's an important risk factor. The second area is, I think there's a tendency to try to rewrite existing technology, right? Like I'm going to have a homeowners company, but it's going to be better and cooler because it's on the blockchain or it's a neat website or user interface. And that's fine. And that's obviously a popular area to pursue. But to me, what's more interesting are lots of areas where there is no risk market right now. And whether that may be in emerging markets where they just don't have a fully developed insurance industry. It may be in developed markets where there are certain risks that people haven't contemplated before, haven't thought about. It could be longer term risk policies. It could be protection for renewable energy. If you don't get enough sunshine or wind or rain, there are so many areas that just aren't well met by either the existing hedging market or the existing insurance market. That just seems like a more fertile ground rather than going and saying, I'm going to compete with somebody who's already doing this in a certain way and I'm just going to do it better, where they're going to want to defend what they do, but going and saying, what are problems that are just not solved right now? And that's harder, but it feels like it's much more rewarding.
Yeah, and you actually gave great, I shouldn't say actually, but earlier you gave great advice around just being a founder in the space period, which is understand what the customers want and start a lot more specifically than you, or in a very, more niche area than you actually think you might end up in, right?
Right, it's easier to start in the niche area and kind of expand from there than to say, well, we're going to do analysis for any kind of security you might own and how it's exposed to climate risk, which seems, impossible.
Yeah. Exactly. Okay. Well, I had a ton of fun. I don't want to give up this conversation with you, but the audience has some great questions. Blake, you have a lot of great questions. So I'm going to bring you up first to ask your top question, or the first one that you want to ask. We'll go to some other folks that have questions, and then we'll probably jump back to you. But Blake, can you take it away?
Sure. Hi. Yeah, I had, let's see, top question. How does a typical insurance company view interventions such as putting flood barrier or improving soil health practices? How do they view those interventions? And do reinsurance operations get involved in that climate extreme weather mitigation? Like how do those fit?
That's a good question. It is something that governments in particular have really tried to encourage. In California, for example, the California Earthquake Authority, which is ultimately the largest provider of earthquake insurance, has spent a lot of time trying to educate customers on retrofitting and mitigation. And here are simple things that you can do, which would make your house a better risk. The difficulty is that insurance companies, as much as you might think this is not the case, they don't really look at every single property and come up with a specific price for that property. They're much more concerned about the performance overall of that book of business. So they can encourage mitigation because the more mitigation and the more sort of climate action is taken, the better it is for their overall portfolio. But one by one, property by property, the pricing that they use and apply isn't necessarily as effective at that level. It's very difficult to say, if you trim the trees next to your house and I did not, that's worth $20 off of your insurance policy or not. They tend to be more of a blunt instrument saying anybody who does this gets a $200 credit, just like anybody who lives near within X miles of a fire station or doesn't have asbestos in their roof or whatever it might be. So it can be a factor, but I think in many cases the pricing problem that insurance companies face is bigger than mitigation. And I'll give you an example. We had a long conversation with somebody who owned a major asset not a house, not a shopping mall, but like a very big and expensive thing. And they said, we're thinking of building a seawall around this thing because we know that sea level is going to rise and we're threatened. Will we get a discount in the future on our insurance for that? And what we had to say to them is, you're probably not paying like the current price for that asset today. And the trajectory in the future for that asset is you're probably going to have to pay more over time. Not to say that you shouldn't build the seawall, because that will mean that the slope of that future trajectory is less steep. But it's not as if you can say, well, if I build the seawall, I'm cutting the risk in half, and therefore I save half of my premium, and therefore I can apply that today to the cost of the seawall. Generally speaking, a lot of these risks right now are underpriced rather than overpriced. So it's important, I think, at a functional level to encourage mitigation, but it can be difficult property by property to say, well, here's like the exact value of that mitigation. So it tends to be, again, like a safe driver discount, or if you have straight A's as a high school student, we're going to charge you less than if you don't. It's not necessarily saying like, I know for your student, it's good that they took physics because they understand what happens when a car hits something. It's more of just a general suggestion in the direction of proper behavior. Another component to that is you're going to start to see municipalities make investments themselves in making their area safer, even if that's not specific to an asset or driven by insurance. So putting in a big sort of cut, for example, in the middle of the forest where it's a fire break, and saying, we just want to have this at the edge of our town in case something comes down the mountain. It's not really driven by insurance pricing per se, but it's simply making an investment that's an important infrastructure investment, in other words.
Thank
Awesome.
you.
Thanks, Blake. Think about your second favorite, because I have a feeling we'll send you back up. Tess, you're up next.
Awesome. Thanks. I was just curious, I'm turning on my video. I was curious how you think about CAT modeling, if you do that in-house, and sort of how you think about bringing the best available science in like an iterative way.
Sure. So, CAT modeling, catastrophe modeling, was really one of the critical pieces to unlock the ability of the insurance and reinsurance and ultimately investor industry to be comfortable taking this sort of risk. And that was the work of really two companies, one in Boston and one in California, that were sort of original insurtech companies long before anybody created that word. Our general view is, like any investment manager, you want to have the best modeling you possibly can. We employ people who worked at all different CAT modeling firms and other statistical firms as well. Our general view has been it's good to license the models to see what is the standard, because everybody uses one of these two or three models. But it's also important to break them open and understand the moving parts inside. And ultimately, catastrophe models are about events, what could happen from a natural hazard standpoint, and about stuff, like what buildings are in the way, or people are in the way, or other assets are in the way. And sometimes they're very good at some events and not so good at others, or sometimes the information on the stuff to which the events happen is better than others. So, our general approach has been to use them and then to try to improve them in whatever way you can. And like any other software product, those are generally designed to be consistent over a long term, and they're not necessarily going to adjust and move around every time new knowledge is released. And one of the nice things about this whole industry is that there are thousands of people around the world every day kind of working for free on your behalf, right? Academics looking at earthquakes and looking at typhoons and looking at flood and publishing papers and information. And like with any software system, if something gets published, it can take a while for that then to be built into the next version of the new software. Whereas we can take it and the next morning say, well, let's go tinker with the software and incorporate those new insights. And that's part of the nature of our business. That's not necessarily something that every insurance or reinsurance company can do or wants to do. But obviously that modeling, that ability to quantify probability is at the heart of being able to make decisions in this business.
Excellent. Thank you, Tess. Alexa, you're up next.
Hi. It's great to listen. And also, you're actually answering something very, very similar to what I was about to also ask, which is that one of the things that it's clear, like in the changing climate, when we're having, we're coming up with summers that we have like surprising amount of heat waves and, increasing temperatures like late into the autumn or whatever sort of extreme events. And so I had like sort of two related questions, which is kind of a follow on what you already said. which is that how much is the landscape changing, in terms of how quickly is the insurance players adopting this new information, and reassessing their understanding of the risk, especially when you're looking at, investing into real estate or anything land-based, where the time horizons are super long. And is this very different across the different players? Like, is there like an obvious that there's much more like, you guys are probably on the sort of bleeding edge, adopting new stuff very quickly, but is there then players that are much more traditional and don't adopt quite as quickly? And I guess, is that then creating pricing change and so on? Like, how do you kind of see this, evolution happening as we're, seeing this like quick change in climate? Complicated question, sorry. But.
No, absolutely. I mean, look, I think it happens very unevenly, right? It's like the old William Gibson saying, the future is already here. It's just unevenly distributed. Like there's, if you think about sort of a matrix or a board of sectors, different sectors are thinking about this differently. Municipal bond investors may not be thinking about it. Real estate investors are certainly starting to think about it, right? Insurance companies in some parts of the world may be thinking about it. Insurance companies in other parts of the world may not be. So it's certainly uneven by sector. And as you say, so that if that's sort of the vertical axis, it's also uneven by player within that sector. And you have to think about, if you were running an insurance company, what are the choices that you have? You might say, I think volatility is increasing. I'm going to load for much more volatility in my models here in England. And then you might be much more expensive than a bunch of people who did not do that and therefore not write any business and therefore shrink. That's hard for somebody who's running a company to consciously choose to do. And to say, well, over time, I think that's a better decision to make. It may make sense for her shareholders, but it has other costs associated with it. And it's hard to point to say, here's risk that I avoided, or here's why this is a better decision. So there's lots of reasons why people come up with a different interpretation. One of the arguments that insurance companies make often is, we only have this risk for 1 year. So to the extent that things really do appear like they're changing, we'll just stop writing in the future, which may be true if you are a reinsurance company and you're saying, I cover this risk in Japan this year and I'll just stop writing in Japan next year. It's harder to say if you are an insurance company and all of your business is in France and you aren't pricing properly for flood or for heat, and then it starts getting wetter and it starts getting hotter. And then, at what point do you say, well, I guess we're just going to stop writing business here? So on the one hand, it can be a little bit disappointing that there isn't a uniform approach, right? You would in some ways, ideally like each sector to say, we're incorporating new information right away. We're going to make better decisions. And here's the price signal that comes out of those decisions. On the other hand, there's a lot more opportunity with the fact that sector by sector and player by player, everybody has their own interpretation of what they're going to do or what they're not going to do with this new information. That obviously creates many more opportunities for investment and for innovation and for differentiation. And we'll see how that plays out. But going back to sort of some of the climate technology questions, we've seen a number of companies who've then picked a sector, said real estate investment, municipal bonds. We are going to go to people who invest in those things, and we're going to build them a tool which enables them to see the impact of some scenario that they've chosen on their holdings, what's going to happen over time. Because again, one thing it may be hard for them to do. You may be a guy who's bought municipal bonds for 30 years and you have a lurking suspicion that the risk profile has changed underneath, but you're unlikely to start subscribing to Nature magazine and making your own conclusions, right? Like you need somebody to give you a tool to help you make better decisions.
Thanks.
Awesome. Thanks, Alexi. Nisha, did you want to ask your question about premiums?
Yes, and I apologize, I'm in a bit of a noisy spot here, but kind of related to that, I'm just wondering, and I don't understand the insurance, industry super well, and I'm just wondering, as a whole, are insurance companies kind of underpricing risk associated with climate? You think about all the models say, okay, with carbon dioxide increasing, we've got increasing, threat of, weather disasters and stuff like that associated with climate change. You would think that, that should be seen in, insurance premia kind of increasing, and then companies, individuals, governments, et cetera, having the incentives to take, different decisions, right? Because, but so I guess what I'm asking is, maybe it's a rhetorical question: is the risk of premia, is the risk of climate, is climate risk underpriced in existing insurance premia? Maybe the real question is like how to get the insurance industry as a whole to properly price in these risks.
Sure. So, I guess I would say three things. One is I think climate risk is underpriced generally, right? It's not just in the insurance industry, but it's in equities and it's in debts and it's in sovereign governments and commodities. It isn't something that has been fully digested and accounted for, right? If you all, and there's lots of levels at which you could apply that, assume a price on carbon or assume certain scenarios that we're on a trajectory to achieve. Real estate. So generally speaking, it's certainly not specific to the insurance industry. Climate risk is underpriced, which is very bad for lots of obvious reasons and also an opportunity for lots of obvious reasons. So I think that's true as a starting point. Specifically with respect to the insurance industry, it is also true, and not necessarily everywhere, not necessarily for all classes of business, but it's certainly true in some places. But they're not holding this risk for 50 years, right? If you said, well, you have this portfolio and you wrote these policies and you are stuck with them for the next 30 years, I think that they would be quite unnerved by that. But again, part of the argument is it underpriced for next year, or is it underpriced for 2030, or is it underpriced for 2040? And it's easier to talk yourself into, well, for next year, maybe it is, or maybe it's not underpriced. It's not as obvious than if you said, by the way, you have to hold all this stuff until 2050. How do you feel now? I don't think they would want the current pricing that they have. But then thirdly, I'll just give you a real example from the United States. You had Superstorm Sandy, obviously, which was basically a huge flooding and storm surge event. And it was a reminder at the time that flood risk in the United States is based on outdated maps. Topography that isn't the same anymore, low level of granularity. There is much better information available. It just wasn't publicly published and used as the basis for flood pricing. When they tried to pass legislation that said, hey, by the way, let's update the flood maps to reflect today's reality, which, by the way, will mean flood insurance premiums go up a lot, that was a very politically unpopular thing to do, and they couldn't pass that legislation because underpricing means if you change the pricing, everybody's going to have to pay more money for protection, and people don't really want to pay more money for more protection or for the same protection. And they came back around to it recently and tried to pass something which was called Risk Rating 2.0. So again, the National Flood Insurance Program, which, by the way, loses billions of dollars every year, it pays out way more than it brings in. It's obviously underpriced and is publicly underpriced and has been basically for its entire lifespan as a federal program. They said the prices today are here and the prices should be here. But because of the reaction against going directly there, that's very hard for people to digest. What we'll do is we'll phase in these price increases, or what we'll propose to do, over the next, I think it's 7 or 8 years, so that eventually we'll get to what the right price should be. So at least you have some trajectory that you can plan on and budget or move or what have you. Even that, it's not clear whether it will be enacted. And by the way, 8 years from now, that will also be out of date because that will be as of 10 years ago. So while it sounds from a capital markets standpoint, like why not let prices float? There's all sorts of societal implications for that. If you're a politician where people now are saying, well, I'm not going to be able to afford to stay in my home, whether it's in the bayous of Louisiana or whether it's on Nantucket, people don't like that. And there's a fine line between insurance as a good, which is arguably what it originally started as, versus insurance as a right, which is, I need this to get a mortgage. If my insurance cost triples and I can't pay for it, like, what am I going to do? And who am I going to sell this house to? Because for that next person, they're going to have the same problem. So it's, you could certainly imagine somebody taking an approach where all of this just flows through at once, but that kind of draconian repricing has all kinds of other societal repercussions that, we're just frankly not ready for or prepared to take on. So I think you're right. I think it's important to note it's true across every asset that we collectively own probably isn't fully reflecting, future scenarios of climate risk. But when you start looking at actual fixes for that, how do you get to a better price? There's a lot of headwinds in that process that involve, people's actual lives.
Excellent. Thank you, Nisha. So I don't think we have time for Blake's second question, but I'm glad that he got in one at least. One thing that I wanted to mention, which we didn't mention earlier, is that you're on the board of Ceres. It's a nonprofit org trying to transform the economy to build a just and sustainable future. And it works with influential capital market leaders, which I would count you in that in that category, of course, to solve sustainability challenges. And it seems like it's, it actually makes a tangible impact, is very influential in governance of companies, big companies, I believe. Would you want to just spend a minute talking about your work there?
Sure. No, I'd love to. The Ceres is a fantastic organization, and I'm proud to have been, part of it for a long time. Their view, which is very in line with the discussion that we've had today, is investors and companies do care about having better information. And the big California pension funds and the New York State pension fund and the largest pension fund in the world in Japan and others have said, if we're investing in your company over the next 5 or 10 or 40 years, and by the way, we're so large that we own all of you in one form or another, we can't not look at the topic of climate risk. Like, this is important to us. We owe pensioners money for the next 10 or 20 or 50 or 100 years. So we have to be thinking about that time span, and we want better information on which to make decisions. And so there's a very large network that Ceres effectively orchestrates of those investors saying, we care about this disclosure, we care about policy. This is a topic that matters to us as fiduciaries on behalf of our investors. And similarly, they have a network of some of the largest companies in the world who are saying, we do care about this financially as well. If we can use less water, that's good for our operations. If we can use renewable energy, not fossil fuel energy, that's good for us and good for our communities. And so those groups are important voices when it comes to policy and decision-making, and when it comes to, frankly, just corporate action. So to give you one example, that group of investors decided they were going to create a list of the 100 largest emitters in the world that are corporate emitters, and are in all kinds of industries and all kinds of geographies, but they're responsible for, unsurprisingly, the lion's share of global emissions. And they went and said, we own you, and we would like you to emit less. And we're not saying you have to go to zero tomorrow. We're not saying you should stop being in the concrete business or the airline business or what have you, but we're just saying, for the sake of all of our communities and our future, how can we are telling you we care about drive your emissions down over time. And we're going to come back to you next year and say, did you do that or did you not do that? And if you're not doing it, then we have other action that we can take as effectively your owners. But we're telling you as your owners, we care. And that matters a lot, right? Then you're really engaging with companies. You're not simply divesting, or you're not simply criticizing them publicly or protesting outside of their office, but you're saying to them, as a financial market actor, I care about these issues, and it should allow you to be a more valuable company if you take these issues into account. And that approach, as somebody who is a capital markets person, always really resonated with me. And it's very powerful when you're talking to legislators, as an example, who have lots of reasons that they make decisions, and they're hearing from employers in their districts, and they're hearing from investors in their district that this matters to them, that having an understanding of where the water goes and how it's being used and how it's valued isn't just a political talking point, but it's a real point of financial value. That's super helpful.
Yeah, it reminds me of engine number 1 taking over 3 board seats of Exxon. Anyway, we are over time. Barney, this was incredible. We could talk for another hour, I'm sure, and I'd learn a ton more. Thank you so much for taking the time to be with us.
My pleasure. Thank you all.
Yeah. Thanks, everyone. Take care.